Generally, the spreads are very thin on these types of transactions, and so they'll make between 50 basis points to only a few percent. This type of strategy requires leverage. We've seen some bonds that were leveraged up to 30 to 40 times to magnify the returns to make it worthwhile for investors. One of the key components that blew up was the subprime component. A lot of hedge fund managers went long on residential mortgage-backed securities in the U.S. that were rated AAA with low yields. They levered them heavily and did not anticipate that these AAA bonds would explode when the subprime market went down the way it did. So this is a strategy that got crushed around the world. Let's talk about why hedge funds were down in 2008. Everyone keeps saying, hedge funds are supposed to generate absolute returns in up and down markets. What happened? So let's investigate what really happened in 2008. Despite what we see in the media, although on average our hedge funds in Canada, according to our reports, are down 20% in 2008, there are some positive stories. I gave you some examples of hedge funds that have performed well in 2008. So it's really the 20% number does not do the industry justice, because you've got hedge funds that return 60%, you've got hedge funds that lost 60% and are even liquidating. So they're all over the map, and to look at one average number really does not justify, does not give you the full picture of hedge funds. However, we will not deny that most hedge funds had experienced negative performance in 2008 and were down with the rest of the market. So let's look at why. The first factor is deleveraging. And, we talked a bit about margin. In a market of panic, prime brokers are going to call the hedge funds and call on their margin. And so a number of them have made margin calls and expected the hedge funds to pay back their loans. As a result of this, hedge funds are being forced to liquidate their assets to meet margin calls. And so what generally happens is hedge funds have to sell their most liquid and best performing assets to free up cash. And so they've been selling off in a horrible market in which they're selling at huge losses and are having to pay back the proceeds of the margin call by selling assets. Redemptions also has a similar effect. Redemptions are basically when investors demand to have their money back. And with all the negative press on hedge funds and Soros and others coming out saying the hedge fund industry is going to drop by 2/3, there's been a lot of doom and gloom in the media. This has caused redemptions on a massive scale in the global markets. Luckily, Canada has been a bit stickier. Redemptions have not been as bad as in Canada, because most of the redemptions have actually been coming from institutions and fund-to-funds, whereas high net worth individuals have stuck around and redemptions have actually been very low on the retail side. So Canada has been lucky in experiencing lower redemptions than other global players. However, redemptions are occurring, and where redemptions do occur, hedge funds are in a position where they need to free up cash, and so they need to sell off their most liquid assets as well, best performing assets, just to free up the cash to meet redemptions. So this is happening across the board. And finally, net long bias. Most hedge funds had a net long bias in the market. They were generally long. There were more net long funds than there are that are market neutral or CTA funds. And so it should come at no surprise that when the entire market is down the way it is in 2008, that a lot of the hedge funds are going to experience very difficult performance. And the only funds that have fared well are the short bias, market neutral funds, CTAs, some of the global macros. But on the whole, most hedge funds are down with the rest of the market. Let's look at some themes for 2009. We know that things look bleak for the industry, and if all you follow is the media, and that's your sole source of information, it looks like this market is going away. However, we don't agree with that. We think that the hedge funds have been put through the toughest test that we have seen in our lifetime. And those that have survived 2008 and that will survive the turmoil in 2009 are going to come out stronger. This is a big shakeout. The ones that engaged in fraud, the ones that engaged that were too heavily exposed are going to be shaken out. But the ones that have performed relatively well, we believe are going to continue to perform well going forward. But what are we seeing here? In 2009, we're going to see more liquidations of hedge funds when they were exposed. We hopefully are going to see that investors are going to be doing more due diligence. We believe that in the market environment that we saw where returns were generally high for several years, a lot of investors dropped their guard and were not doing due diligence, and we think that there's going to be more robust due diligence going forward. There's going to be a greater focus on operational risks as well. A lot of investors look at previous performance, past returns, and they invest only on that premise, whereas they should be looking at some of the operational risks, how many people work in the firm, all the way to the fact that do we have two people signing checks, some of the checks and balances on the operations side. There's going to be increased transparency as well. A lot of hedge funds do not disclose their trades to investors, and I'm going to take a minute here and actually explain why that is, because I talked to a number of hedge fund managers and I asked, and people are curious, why the black box? Why do hedge funds not disclose their trades? And I'm going to give two reasons that I've heard. Not to say that they're right and not to say that they will hold up, but just to give you the reasons. The first reason being that if a hedge fund has a significant short position in a stock, they do not want this to be revealed to the market, because what can happen is some other fund managers could exploit this information and start buying up the stock to drive it up in price. And this hedge fund that has the short position may be in a position where they have to cover their short position, thus causing a pop in the stock, and therefore people having this information be able to profit off of it. So this is one of the first reasons. The second reason why hedge fund managers are hesitant to disclose their information, and this is mainly for the reason for disclosing to institutional investors, is that if I'm a hedge fund manager and I disclose all my trades, it's not inconceivable, and it has happened in the past, that various institutions that have equity desks that have their own research will call and say, hey, Daryl, what's with that ABC stock? We have a sell rating on this stock. Are you going to get rid of it? Because if you don't, we're going to pull our money out. And what ends up happening is you have several cooks in the kitchen, and you have several institutions phoning you and telling you how you should trade your portfolio. So portfolio managers feel that they lose control of their portfolio as a result of disclosing their trades. Whether these reasons are going to hold up with the regulations that are coming, that remains to be seen. This is a segue into my next point, that there's going to be more regulation. It's going to be interesting to see how it comes and in what form, but the regulatory bodies have to be perceived to be doing something, so they are going to be making some changes in the industry. There's going to be pressure on hedge funds to lower their fees as a result of everything that's happened. Trust will need to be rebuilt in the industry. It seems like there's been a significant damage, and the press only reports the bad stories that are going on with hedge funds, and so this is what people read about. So the impression on the street is all hedge funds are bad, engage in fraud, and they're all black boxes, which hopefully you learned today is not necessarily true. And hopefully there will be a better understanding of hedge funds as a whole, in terms of a hedge fund is not a hedge fund is not a hedge fund. You can't just look at a hedge fund and think that it's the same. You have to evaluate the strategy, determine if the strategy matches, what you think is going to happen in the market, is appropriate for your risk-reward tolerance, and hopefully there'll be more education going forward. And further to that, I believe that there will be more diversification from long-short. We're going to see new emerging strategies going forward in the industry. That concludes my remarks for the afternoon, and I'm going to open up the floor. We'll take questions for 20 minutes until 3 o'clock. So I now open the floor for questions. If you have a question, please press *1 now. I have a question here from Andrew. Andrew, please go ahead with your question.
Hi, thanks for taking my question. It's about margin. From what I hear and from what you had in your slide about prime brokers withdrawing margin from hedge funds, it sounds to me as though hedge funds are not subject to the same regulation T that the rest of us are subject to. In other words, I can borrow 2 to 1 when I'm purchasing equities, but hedge funds can borrow, 100 to 1, but they're legally subject to a different set of regulations that essentially results in contractually arranged amounts of margin. Is that correct?
When it comes to hedge funds, but we can get back to you with more information.